All right. So, hey, everybody. Look, I am really excited about this conversation. In fact, I've been trying to set this one up really for months, right, Matt? We had, talked about this long before COVID. We started this dialogue back in January as to sharing your story about becoming a real estate investor, creating rental properties, which you and I go way back into freshman year of high school. Really, it was a swim team, right?
Yeah.
Well, dive team for you, swim team for me.
Yeah.
The so, but tell me a little bit about kind of who you are, your background. You're a Colorado kid, you're Michigan family, right? So, but you were born here.
Yep. So my background is, born and raised in Golden, Arvada area. My mom's side of the family is from Michigan. So we have some Midwest roots where we go to northern Michigan and go hang out on the lake up there. So that's been, of course, great. But love Colorado, haven't ever left. And as you said, we met on the swim team. I was swimming in that time, freshman year, but every time I was swimming those laps, I was looking at that diving board and all, how much more fun it looked to dive. So that's why I made that transition. Wasn't the best diver around, but it sure was fun. So,
yeah.
Yeah.
Well, when your coach has you do a 200-yard butterfly because you splash her, all of a sudden diving looks really fun.
That's right, man. That is absolutely right. So,
but I am scared to death of heights. That is not my thing.
You know what? It was a good time. And you know what? I think I found out that I was a little more scared of heights than I thought too. So, after that, I went up to CU for business school, and my degrees are in finance and real estate. So things kind of fit pretty well with the industry I fell into in 2007. And, you can stop me if we want to kind of maybe stop there, but that's where the rest kind of takes off. So.
No, I mean, it's good, right? You've kind of nerded out on numbers to say, to put it one way, right? Which is great. You and I speak the same language. We love numbers because ultimately they kind of tell a little bit of a story, right?
Yeah, it's true. I started originating mortgages at 22 years old in 2007, right out of business school. And when I started, I just remember thinking I was pretty confident with my knowledge. And day one, I was quoting interest rates, and the way I thought it worked is completely the opposite of how it works. And so I just remember thinking like I got to tell everybody how it really works, because it seemed like some of the consumer sentiment and just kind of the industry's evolved so much that how do you know what you don't know or what's out there? And I felt very lucky with at such a young age being able to pull back the layers of a bunch of people's credit profiles and help them get pre-approved before I even owned a home myself. So I was able to take that knowledge and really create the framework for my own credit profile in order to accomplish the strategy that I wanted to accomplish. And so, that's really kind of, my wheelhouse, I feel like, and I definitely nerd out big time about it. My wife will attest that I probably talk about mortgages more than is healthy. So, but it's been something that has really just changed my life, and it has gotten me into owning my first primary residence to multiple investment properties, multifamily homes. We got a mountain house, short-term rental, and as Colorado boys, we love going up to the ski areas. So, and not having to be stuck in so much traffic. So, it's been such a wonderful, life-changing, knowledge, skill set to have that I felt lucky to be able to utilize. And my job and my team's job here is to just really be able to plug in with clients and try to understand the deeper levels and the goals of what they're trying to accomplish and help them get there. And that's where we can provide a lot of value as loan officers, because, most people don't really maybe understand how the 2008 recession affected the lending market, where really government kind of took over all the lending products. So at least, 95% of them. And so, when we're all selling the same thing, I've worked at Wells Fargo, I've worked at a couple other different companies before at SWBC. We found a great fit here. When we're all selling the same thing with the same rules, with more or less the same interest rates, it really comes down to who's going to spend the time with you, learn about who you are, what you want to do, and create that strategy to accomplish what you're looking to accomplish. Not everybody is looking to invest like I did pretty aggressively, but that's really our goal, is to identify those different strategies and serve our clients to the best of our ability, really. So.
Yeah, and you're passionate about that. I think you and I share a similar sentiment in that, we look at our job, our role is to really help people develop wealth through real estate ownership. Now, your story is one that I took kind of a similar path. Now, I did not get nearly as aggressive as you did, and it hasn't paid off nearly as well. So let's go backwards, right? Let's start at the beginning. You were young, still working at Wells Fargo, and like a lot of folks, you wanted to get into home ownership. So you bought a house.
Mm-hmm. Yeah, I did. Right? I started at 22, and I worked real hard, and 3 years later, I had saved enough to have a little bit of a down payment and to buy my primary residence. And when you're helping a ton of clients get pre-approved to buy houses, and some even at the time were even my age, it really helped me set those home ownership goals at a young age. And so I encourage everybody listening to, it may not be the strategy that you want to implement, but at least move forward with getting all the knowledge that you can, because some of the things that you may not be aware of can really be the difference in if this kind of strategy is worth it or not. And so when I bought my first home, I had a bunch of roommates. I was 25 years old, and I was of the mindset of, I have a finance background. And so to kind of provide some context, that the first time I quoted an interest rate, I was quoting a 1% origination fee because that's what I was told. And when I saw how much money that was, it was more money than I had to my name. And so I asked my manager, I said, what is this for? Like, what was this paying for? Who's getting this money? And my manager said, oh, don't worry about it. It's a 1% origination fee. It goes towards getting the rate. And I was so fresh out of business school that I'm like, wait. You have these break-even point, red flags going off. And I was shocked, absolutely shocked that as loan officers, we weren't giving that decision to the client. And it kind of seemed like we were okay with the public thinking that I got to go get the lowest rate. And like have this almost anxiety and panic about like, if I get caught around the water cooler with not the lowest rate, I must have got, taken advantage of in some way. And
I got hosed, right? Because
exactly.
my coworker, my neighbor, they all have better interest rates. I'm the sucker that paid more. Right. And I came from a motorcycle industry, and I love the industry that's there, yet it's a different perspective because the interest rates are pretty much all the same, and paying the lowest interest rate does not always equate to the best deal as much as we want to pound our chest with that. So,
exactly.
As you bought your first house, you didn't jump into it saying, hey, this is going to become a short-term rental for me in the future.
No, I didn't. I bought it just knowing that home ownership was the right call financially for a lot of different reasons. For the tax write-off you can get, for the principal pay down that you're paying down what you owe every single month. Hopefully your assets appreciating. Obviously that's maybe a more talked about topic about home ownership and home values. But my kind of rule of thumb that still proves to be true is that you only lose money in real estate when you're forced to sell in a down market. And so you kind of have to be cautious and be prepared for what you may do in those down markets. But I was always pretty conservative and bought my first house, and just I had a lot of roommates, and I was trying to acquire some capital because I wanted to invest in real estate eventually. But I kind of realized that the ticket to the game was access to capital. And so, I kind of utilized this. I bought my house in 2009, and nowadays we're pretty used to these low interest rates. 3% on a 30-year mortgage. It's crazy to even consider something like that. But yeah, at the time when I bought my first house, it was 4.875. My rate was, and if I had a crystal ball, I did it the right way. But nobody does have a crystal ball. But I was more looking to acquire capital. And so when I recognized that you didn't have to buy down your interest rate, and that was thousands of dollars to do that, it creates a break-even point. Because what happens when you buy down your interest rate? What is the only thing that happens? Your payment drops, which is good, right? You pay lower interest and your payment drops. But you better make sure that you're going to be in that mortgage or in that new payment for long enough to recoup what you're spending to get that lower payment, right? So that's the question. It's really as simple as that. And so when you think about it in those terms, it kind of actually, the stress kind of melts away of, I got to get the lowest interest rate, because interest rates fluctuate each day, depending on your credit score, your down payment, condo, single family home. There's so many different variables that can affect your pricing. So, I encourage people to plug in and to kind of understand the strategy and understand how we're qualifying people, because that's really, how we can demonstrate our value to the clients, right? And so
well, and as we put this into perspective, right, for folks that may have never bought a home before or don't understand. So when you buy your first home, you have your down payment, right? Most folks understand a down payment. When I go to buy a car, when I go to buy a motorcycle, I have my down payment. And now you have that with your home as well. And depending on your vet status, right, if you're served in the military, right, and you can take advantage of the VA loans, could be as low as 0, could be as high as 20%, but there's FHA and conventional where you can get to 3.5, maybe 3 on some conventional programs, or typically around 5%. So you have that. Then you have your closing costs, right? Yep. And these are the costs that are third-party closing costs. There's some lender costs in there. Oftentimes they're about $4,500. So essentially what you're sharing is that a previous company that, as they were talking to you, they would help folks get the lowest interest rate, yet they would be charged a premium on the fees up front to buy down that interest rate. Is that right? That's so right. They're basically paying for it, but they're paying for it up front. Now, my payment may be $50 lower a month, but when I do the calculation on how long it's going to take me to recoup that may be a long time, right? Yep. So now you bought, your first interest rate was lower than mine, by the way. So kudos for waiting or timing it, or maybe, foresight. I just bought mine at a better time.
Well, one of the things that maybe, we did have employee rates. So that is a little perk.
There it was.
Not much better, but yeah.
So interest rates, though, kept dropping, and you recognize that, hey, it's advantageous for me to reduce my monthly payment, to refinance, to drop that rate. So you would continue to do this on a regular basis. I think you said you were doing it multiple times a year, at least every year.
Yeah, because it depended on what happened with interest rates, right? Because coming from the finance background, and knowing that, like, hey, there's no prepayment penalty, you can refinance again if interest rates drop. Well, okay then. Interest rates just dropped. So why would I keep paying a higher interest rate? Well, why you maybe wouldn't want to refinance is if you just paid thousands of dollars to buy down your interest rate, or you just incurred a lot of fees to refinance. Well, if I paid all those fees, right, and it's going to take me 3, 4, 5 years to recoup that. Well, I don't want to pay those again and set myself that far back to save $25 on a monthly payment. But that's not what you did. No, exactly. So I like to start when I look at a refinance, right? Because it's all a finance question, and we got to look at how much it costs and what you're going to save. And so I even took it one step further, because there's about $3,000 of rough fixed costs involved in a refinance. These are mostly third parties. There's one SWBC charge, which is to pay our processing team and underwriting team. But other than that, it's the appraisal, it is the title work, and it is the closing fee, and it is the recording charges with the county. And so when you have those fixed costs, you learn in business school, there's no such thing as a free lunch. And those people have to get paid because they're doing their job. But the interest rate is we quote interest rates on a spectrum. And so you can potentially look at maybe what the interest rate would be if, and as well as instead of charging an origination charge, you'd give back a lender credit, or what's called a credit for interest rate chosen. And so you take a higher interest rate, but you get your $3,000 paid for, right? So if we can take care of those fixed costs and say it's truly free to refinance, and you're still dropping your interest rate from where you're at, well, then in my mind, that makes sense to do. But does it make sense for that specific client to go through all the refinance, hassle to do that? That's a question that can depend on the clients. But, that's where I start from. And you can't really do this as much these days because I feel like, the regulators kind of caught on to it. But, I was with interest rates dropping progressively every single year, it felt like I wasn't spending money to refinance. If I could still drop my interest rate and have all my costs paid for, and then there's another thing that's collected for the refinance, your property taxes and your homeowner's insurance, which aren't costs of refinance, and they're a cost of owning a home. And so at the time I was getting those paid for as well, because it didn't really matter to me to drop my payment maybe 60, 70, or 80 more dollars. I wanted to have my thousands of dollars of property taxes and insurance paid for so I could start acquiring that capital to buy my investment property that I was looking to.
Yeah. So then one of the things that happens during a refinance process is you have this guy come by your house and tell you what it's worth, right? Now, you've been in since you were 22. I got started a little later in the game. I was 29 here when I got into real estate as far as a business, right? I bought my first home at 23. But you've got somebody that comes by and they do an appraisal on the house. Now, you bought your home, what was it, 2010, 2011?
December 2009.
Okay, so yeah, 2009. Now, the market has appreciated really well since then. Now, not everybody watching this video has had that same appreciation yet. We're still seeing appreciation today versus what it was last year. So, let's again kind of jump forward. You're going through this process of continuing to refinance the house. As interest rates are dropping, you're taking advantage of that. You get a favorable appraisal because everybody loves your neighborhood, by the way. I mean, it was a hot area to be. That crystal ball you had, picked the right neighborhood at the right time. Yeah. But by the way, yeah, for the folks that are watching, if you didn't happen to buy in the Highlands in 2009, it doesn't mean that this isn't possible for you. The house that I bought in Greeley in 2008 is worth significantly more than I paid for it in 2008, right? It has gone up almost 3 times what I ended up paying for it back then, right? So still neighborhoods are appreciating. This is still something that happens. So you got a favorable appraisal and you pulled equity out of the house.
Yeah. I was at the time, because, we got to think about the market back in 2009, and not everybody was rushing to buy a house, but there were opportunities. And I was watching and helping a lot of real estate investors get qualified to buy investment properties. And when you're looking at buying a primary residence versus buying an investment property, and especially a duplex or a fourplex, which I was looking at, the maximum down payment percentage increases pretty drastically. And so that's what I'm talking about for that access to capital being so crucial. And so just refinancing because I could just save a little bit of money, have a little bit of taxes and insurance paid, just kind of business as usual. And the appraiser came and I got a really good appraisal. And so what that meant to me immediately was that this is like a ticket to my investment property right here. So I used it to get a home equity line of credit that I could tap in.
How much did you pull out for that home equity line of credit? If you don't mind me sharing, I'm going to put you on the spot. Just throw it out. Everybody's going to know your financial.
Yeah, I got no problem with the numbers either. It was a little over $90,000 at the time, and so you had to put, it was a fourplex, and so you had to put 30% down, and so everybody would be loving the numbers that we bought it for now for a fourplex, but coming up with that $90,000 was tough to do.
House. So this wasn't trading time for dollars. This wasn't picking up a second job or a side hustle. You took the equity out of your house. You took $90,000 and used that as a down payment on a fourplex.
That's right. Yeah.
To buy another piece of property, right?
That's right. Yeah. And the important part about that, and I want everyone to make sure that we know, is that, as long as you can debt service for that payment. So when you get a home equity line of credit and you tap into that equity, typically they, and that this type of credit market is a little bit volatile right now, a lot of it volatile right now during COVID. But back during the time, you have a payment, it's interest only, but you have to be able to qualify with that additional payment and that new payment. And so really it was managing debt to income ratios. And so that's where, is really the strategy and knowing at 22 how to kind of shape my credit profile, with knowing how kind of the regulators, lend, is a really, really important, knowledge base that we're happy to share with any clients that would give us the time. But really that's where I determine that the loan officer's values is that we can help come up with that strategy, right? So I had that home equity line of credit. I knew that I could qualify with the payment as well, and I had the properties that I was looking for. And so when everything kind of fell together, I had my team, and that's another thing that I want to reiterate. Where if you are going into something like this pretty aggressively, you want to have a reliable team of specialists that you can trust in the different areas. And so once I was able to do it, we identified the property, pulled the trigger on the first fourplex, and that was in 2011. And shortly after that, bought a duplex.
So where'd you come up with the money for the duplex, right? Was this the same $90,000? Did you refinance again? Where did the money for the duplex come?
I had kind of an ace up my sleeve a little bit, where my father had got into the real estate investing a little bit earlier, but he was also, I love my dad because he never really handed anything to me. And I don't want to say that as far as like, he handed me everything as far as knowledge and the power to do it myself. But it was more of a tough love type of approach. And so, a year before I bought that investment property, I took my dad out to sushi. There's this place called Namiko's right across from Wells Fargo in Arvada. And I thought I was pretty much a hot shot at that point, 24 years old, had 2 years originating mortgages under my belt. And, I told him about how I understood how he did his financing and did everything. And I was really impressed, and I really wanted to be part of it. And he just cleaned his plate and he smiled at me and he said, "Well, that's great, Matthew, but I struggle to find what you bring to the table."
I met your dad and you shared some stories, and this is absolutely fantastic, right? You pitch this to your dad and you're saying, "Hey, great, this is what we can do, and we can do all of this." And your dad looks back and he says, "Yeah, I can do this. I do this. What do I need you for?" Right?
Yeah. And you know what? That's the best comment probably I've ever been told in my life. From someone who loves me. It's like, "Hey, man, go back to work. Bring something to the table, and maybe we can talk about this." And so you kind of,
As I interject here real quick before we jump on, which brings me to the 3 F's when it comes to real estate investing, in my opinion, right? It comes down to 3 things. 1, can you find it? Right. So if you can find a good deal, a good rental property, a good flip property, people will pay you for that service. Now you have to be able to identify that it's a good deal. You have to be able to know that the numbers work, right? You have to be the one that has the inside track. And this is what wholesalers do. I've got a good friend of mine that does this, right? So that's 1 F. 2, can you fix it? Are you the one that can get in there and do the repairs, do the rehab, do the updating? Can you fix this property and make it better? There's another way to get into the real estate investing. And then 3rd is, can you fund it, right? Can you be the one that's got the capital invested to make this happen? So 1, if you don't have the funds, can you do one of the other 2 F's? If you're not handy and you can't fix it and you can't fund it, well, you got to be able to find it, right? And that's opportunity to learn and to get into to know what's a good deal. Because truth be told, there's a lot of investors out there they would love to put money into real estate if they found the good deal. They just, it needs to kind of fall more into their lap, and they'll pay you for that service, right? Yeah. So, your dad eventually kind of runs into this spot where he's kind of maxed out, and they won't lend him any more money. Right.
That's right. Yeah. So, and that happened after that sushi appointment. So it was about a year and a half that, I went back to the drawing board. I let that knee-jerk reaction of being upset, process, and then got back to work and realized that my dad was absolutely correct. And that was wonderful advice. And I needed to figure out what I would bring to the table. And the lending business was changing rapidly at that time. Rules were changing, and this is what's going on even to this day with COVID. I mean, there's so many different lending rules where when he was in investing in early to mid 2000s, you could fog a mirror and get a loan. And it's a little different.
Literally, I think that was on the application, right? First name, last name, can you fog a mirror? Here's $450,000.
Yeah, and I know firsthand where the first 6 months that I was at Wells Fargo, the second half of July, we had this program called Straight to Close. And so what that meant was if your credit score was above a certain amount and your income passed the reasonably of income test, which means, okay, well, makes sense for somebody in that job to have that income, then
walks like a duck, quacks like a duck.
Right, that's right. But keep in mind that the client is responsible for entering in all this information. And so who knows if that's their job or not, right? So
I took a lot of credit applications at the dealership. There's a lot of folks that don't really know how much money they make, and that's okay.
Right, exactly. And or how an underwriter would determine that. But back in that time, it was just, all right, no documentation. It was called Straight to Close. And so going from that world and just seeing the last little window of that world to this, more regulation heavy world where I feel like, we're shepherding clients through all the different regulations, even if we have all wonderful clients, that are fully qualified, but still we need to make sure that we're navigating them through these guidelines because, they can have a huge impact. But these guidelines changed and they capped the amount of conventional mortgages you were allowed to have. And so, boom, my dad couldn't get any more financing. And that was great because it created a window and an opening for me. I had, worked very hard, had roommates, paid down most of my debt, and I could qualify for an investment property. And so when you talked about the 3 Fs, I could fund it. And so what I did was I called up my dad again, took him to the same sushi place, and I said, I laid out all my value propositions, and I was even going to find it for him, right? And so he agreed. I brought some stuff to the table there, and so we decided that we'd take a look. But that was just the start, right? Because then I was obsessed. I had MLS credentials at the time, I want to say, and I just searched every single day for multifamily homes, and we had our kind of run numbers analysis, ROI kind of process that I would just go through, and then I would kind of send it to him for his review, and he would just shut me down on every single one. So finally I begged him to take a look at his fourplex, and I got him over there. He took a look at it, and that was our first property together, where I qualified for it completely by myself, but he was a silent partner. But I told him at that sushi restaurant, my mortgage business, my clients meant, they were my priority, and he was a property manager of his own properties. And so part of the deal was, what is a property manager rate? What are the property manager rates? He told me 8 to 10%. Because I trust him, he's my dad, and I know he's darn good at what he does. He didn't even negotiate. He said, you can get 10%, but you better not bother me with, water heater going out. When I got mortgages, I need to figure out, for my clients out there. And so
you make it your dad brings something to the table.
That's right. You know what? He said, don't expect anything for free, even from your family members. So I told him the same thing. So, but it was a good fit. And that was the first property of 4 total multifamily homes. That was the first fourplex, but we did the same thing with 3 duplexes after that. And, it just planted the seeds for a really nice foundation. Never stopped putting the pedal to the metal in the mortgage business. So I've been able to focus on that. But we sold that fourplex in 2017, and 1031 exchanged that into that mountain home. That was kind of, my dad and I's being Colorado boys' dreams, where we're able to bridge that gap where we can still, cash flow on it, which is kind of, our thing, but we can go up there and enjoy the mountains with my wife, mom, my brother and his wife and new son out in Texas. So been very blessed to, how everything worked out, so yeah, I'll pause there, see if you want to elaborate on any of that. So
well, no, so how many doors did you have total? So when I say doors, right, a duplex is 2 doors. There's 2 families that are renting. Fourplex is 4. Single family home is 1. Just for the folks that aren't up to speed. So how many total doors did you have? Really, kind of at the peak, because I know you've changed some things.
Yeah, at the highest, 13. So been very good. Mostly multifamily, and then now not as many doors because we traded 4 doors for 1 door one big door up in the mountains, right? And then
and really changed the cash flow. So all of these up into this point have been long-term buy and hold properties, right? We've got tenants that are on annual leases, or maybe it's month to month. Now, some things have changed, right, with our world around technology. And we have this platform called Airbnb, VRBO. We have short-term rental platforms. So you take this opportunity to buy a property up in the mountains. And by the way, where's this located at again? It's not in Breckenridge. It's
Silverthorne. Yep.
Silverthorne.
It's in Eagle's Nest, if you're familiar with that area.
Yeah. So if anybody watching wants to get up to Eagle's Nest for a ski weekend getaway, just hit up Matt and he'll get you the details on his mountain palace.
Hey, it sleeps up to 16, so it's definitely for a family getaway. So
yeah, so we're changing the cash flow conversation because you can get an increase in cash flow when you have the Airbnb rented out on a regular basis. You can increase that rental income versus on the long-term tenant, right? Now there's a little bit different risk. If if I've got a tenant in there, they've signed a lease for a year, they're in there for a year. We're signing a short-term lease, right? A contract with somebody for 3-4 days, right? Maybe 5 days or a night, depending on what that looks like. So changing the cash flow, you really became a student of this. Now you have how many short-term rental properties?
Yeah. So the mountain one, and then my wife and I got a duplex down in Colorado Springs without my dad. And so we have a long-term rental in the bottom part. And then my wife manages the upper unit, and she does a great job with that. And so we we have the 2 short-term rental listings, right? But they couldn't be further from each other, right? Where one's a 5,000 square foot house, and the other is a 800 square foot loft above another unit, right? So
yeah,
it is great because and kind of funny because my dad's come from this long-term rental world, and I'm maybe this new age short-term rental world, and we've kind of had some healthy business disagreements and agreements on the pros and cons of both, and actually doing both of them. There's definitely pros and cons to both. I think one of the best pros is that with the short-term rental is that you still can use the property. You can block out certain parts of the year and use the property. And that is so valuable, especially for a ski home, where we want to go up there and utilize it. But, maybe for our property down in the Springs, I wish that was rented every single night, because we don't really go down there as much, right? So, so there's maybe a little bit of a different strategy there and some different pros and cons. You can definitely make more return on the short-term rental side of things. It takes a little bit more of being proactive. You got to, kind of deal with each booking as almost, this is definitely, it's a lot more turnover, right? And so if you have the capacity, I encourage it, if that's something that you feel like you'd be good at, communicating with clients and getting their bookings kind of squared away. My wife is so good at that stuff, but I'll tell you, during the day when I'm trying to focus on my mortgage clients, that oh, Airbnb request. That would drive me nuts, right? So thankfully, I don't have to manage a lot of that.
You got to reach out to Mrs. Collett, right?
Yes,
on the Airbnb. Don't reach out to Matt. So I'm sure we can get her.
Me, I'll be like, let me ask my wife. Yes.
Yeah. Let's go to the talent. You're just like me. We both outkicked our coverage in the marriage side of it, right?
For sure. That is for sure. Yes.
So now, how many long-term rentals do you have today?
Mm-hmm. Yeah. So
how many doors?
I have 1, 2, 4. Well, five if you include commercial. I did buy the office space that our mortgage team works out of, and so it's kind of nice to, as the mortgage business grows, to know that one of my assets is direct and tenants is directly tied to my own mortgage team. So it's kind of a nice fit that way. And it took a while to figure out, I've kind of put that in the goal category about 4 or 5 years ago, but it finally happened at the end of January, and couldn't be more thrilled, getting in here. And I got 2 business partners where we're all, part of the same operation. We're each try to be each other if we can, because it's all about providing knowledge and time and energy for our clients. And so I found out pretty quickly when I was by myself that you can't do it all. And so that's why we got a team together, because we want to be the best.
Well, and so, right, if I'm keeping track here of the numbers, we have 4 residential long-term rentals. We have 1 commercial property. Mm-hmm. And we have the 2 Airbnb type properties, and knowing a little bit, there's several $1 million worth of real estate that you own. Is that fair to say? And you don't have to share the exact number, but I know the Silverthorne house isn't cheap, and I know commercial space with where you're at is not cheap. So several $1 million worth of real estate. And this, truth be told, started with 1 single family home that you bought. Mm-hmm. You got a favorable appraisal as the market appreciated, right? And this is one of the things that I love about real estate in general, right? We weren't working and grinding and saving up that money every day. The market gifted that with appreciation. And that's one of the glorious things about real estate is I can stay in this and I'm making money 4 different ways. We have appreciation, right? We have cash flow on the rental properties. 3, you've got tax benefits for owning real estate. And then 4, you have the debt pay down. Mm-hmm. So overall, this was a smart investment at a young age that equated into now millions of dollars worth of real estate that's owned that, for the most part, somebody else is paying. Now, even on your primary residence, you Airbnb that house there in the Highlands still, right?
No, not anymore since COVID. My wife has Lyme disease, so we're being careful about exposing her.
So pre-COVID, you were still doing that.
Yeah, actually, my business partner Nate was doing it a little bit more with his primary residence, and he had a lot of success with it. It was definitely more aspirational for me to do a lot more frequently. But once things kind of changed earlier this year, we had to pivot a little bit. So
yeah, of course. So you dabbled in it a little bit. So of all the real estate that you own, pretty much somebody else is paying the mortgage for all of it.
Yeah.
So we're seeing the cash flow and things are working out there. Now, I've got another friend of mine. I took his class on real estate investing, a phenomenal class, great investor, smart guy. Asked him the question, right? I can't go back to 2009 in December and buy a house in the Highlands. Yeah, that's not possible. Yet, what I want folks to know is this still can be done today. We can still do this today, right? Yeah. So if you were to start today, right? You'd never bought a home before. What would you do?
Yeah, great question, Matt. And I actually feel like in hindsight, I played it pretty well, but I would have done it a little differently, knowing what I know now and knowing the flexibility that I had back when I was in my mid-20s. Multifamily homes they can create a better asset for you. And so if I would were to do it over again, I would have bought my first primary residence as a duplex, or a
Okay.
multifamily home of some sort, because you're able to, whereas duplexes and fourplexes and triplex, they take even more down, the more units you add, for an investment property. And so if you're able to buy a multifamily unit as a primary occupancy, it will limit your down payment. So remember when I said access to capital was the ticket to the game? Well,
Yeah.
it's gonna make it easier to get that ticket to the game, and then you're moving into a place that it's not in the mountains to manage. It's not in the springs to manage. It's a lot easier to manage. Maybe just the other side of a duplex.
Knock on the door. Your music's too loud.
Yeah. Or when I was, it would have been a lot nicer. I had at one point 7 guys living in this house in the Highlands with me. One lived in like a Harry Potter cupboard below the base stairs, And,
if there was an open spot, Matt's finding a tenant to shove them in there, right? You're putting in bunk beds.
That's right.
Making some things happen there just to maximize your return. So, and just to catch up, right? So if I'm going to buy an investment property, I have to have 20% down, right? So 20% of $400,000 is 80 grand, right? That's the money that you pulled out of that one home. Yet, if I can take advantage of FHA down payments at 3.5%, I'm looking at just under $16,000 to buy a $450,000 property, right?
Yep.
So massive difference in just the down payment that's required. And, I had roommates in my first house when I bought it because, I looked at it as somebody else should be paying my mortgage, and if somebody needs to live somewhere, might as well, live with me. Yet I had some awful roommates at times, right? I had some roommates that got stoned and forgot they were cooking stuff on the stove. Other ones that would sneak people in the middle of the night as I'm, trying to get up at 4:30 in the morning. Some people that just were not clean. Yet if I had a duplex, they can, be filthy and, forget their cooking and leave leftovers in the fridge. It doesn't matter, right? I don't have to worry about the duplex tenant coming into my house and eating my ice cream.
Exactly.
Right?
And you know what? That's exactly what I was getting at, where, living with 7 guys had in a 1,900 square foot house had its drawbacks, as you can imagine. So to be able to have your own space and then also get the benefit of having that rental income to help pay that mortgage, and it was a win-win. They all loved it too, as far as, I like the cash flow, but I was obviously trying to be pretty aggressive there. And so doing it over again, it would have been nice to have a little bit of that separation. But even then, you can, you have a couple bedrooms on both sides and you got a best friend, that is not going to be a bad roommate, then, maybe
still vet the best friend. That's my advice. Still vet the best friend if you're going to be having them live with you.
That's true. That's true. That is true.
There's some friendships have been ruined by becoming roommates. Right?
That's true. Yeah. So, but that, as far as cash flow, and you live in it for a year, and can look at buying another place. Can look at buying another primary residence, and then once you leave, you can rent out both sides. You all of a sudden have 2 doors, like you're talking about, and fairly certain, without seeing the specific scenarios, is that you're probably going to be cash flowing pretty good in a scenario like that. Just especially where interest rates are at, and that's another benefit that we didn't touch on, which is a huge benefit versus primary residence versus an investment property, is that interest rates are a lot better with a primary residence. And so think about how rates get worse. There's a bunch of different variables, and the way I kind of look at it is there can be positive variables or there can be negative variables, and a negative variable is another unit in the property. And these negative variables can compound on each other. And so if there is a fourplex, say, plus you're buying it as an investment property, plus you're putting the minimum amount down, plus you have a 680 credit score, all those different things could result in your interest rates being so high because they compound on each other. And so when we're looking at, sometimes we can't control really, some of those things, but when we can control it to our benefit, to our favor, then that's how you can implement strategy in your home financing. And that's what we want to come up together with, that strategy with you, and take the time to do that, because there's so many different ways that you can structure your financing. And to have better interest rates on a primary residence duplex that in 12 months will be an investment property. Well, then living in that place for 12 months, I mean, you can just look at the comparison for what you would have had to do to buy that as an investment property, and what your rate would be, and how it affects your cash flow. It is a game changer if you have that flexibility.
Well, and it takes a little bit of thinking outside the box. It takes a little bit of flexibility. Now, you can do what we're talking about doing without necessarily having to buy the duplex. I mean, the duplex is a great option. So is a triplex or a 4-unit. Beyond that, you get into commercial loans, and things just get a little bit different. Sure. Yet, you can rent out rooms in your house, much like Matt did, right? You can get into this a number of different ways. So let's flip this a little bit, right? Let's say I bought my house 3 or 4 years ago, and I have appreciation in it. The market has gone up over those last couple of years. What might that look like? I decide, hey, let's take advantage of the great interest rates. I was quoted an interest rate 30 years at 3%. That's 3 percentage points lower than what I bought my first house, which is 5 percentage points lower than the historical average. I don't know how much lower they're going to get, if they can get lower. It's an exciting time, and I'm not going to be shocked when they go back up, right? Yeah. Still keep in mind they're still good. So I can take advantage of that. Let's say that I don't get, a $90,000 equity pullout, but I can pull some equity out of my house and find some investment properties to be able to move into, to purchase, right?
Yeah, and here's where we want to be a tad careful about occupancy, because if we do, say, a cash out refinance, as a primary residence, then you absolutely can use that cash out that you've taken from the house. And since rates have dropped so much, you may be even improving your interest rate from where you were with your last rate term refinance, or when you purchased it. But you can definitely use that capital to buy a new place. Here's going to be the what we want to be aware of is that occupancy. When you do a refinance, you sign an occupancy disclosure as a primary residence that it is your intention to live in that property for the next 12 months. And so I want to make sure that we're not getting our clients in any type of trouble where they're not aware of something that they're signing. And if you are going to do a cash out refinance as a primary residence in order to use that money to immediately buy another primary residence, that wouldn't be something that we could do, because
loan fraud, right?
Yeah. Because when those two loans would get sold to Fannie Mae and Freddie Mac, which they buy all the conventional loans, they're going to say, wait a second, we have 2 primary residences in this loan package for Matthew Collett with, 92484. It's his birthday. Like something's going on here, and that's like the easiest red flag that you're going to get in trouble, right?
So let's say with it, I'm going to pull it out. Maybe I'm pulling it out because I'm going to move out of it, right? And I sign a paperwork that says, hey, this is going to become an investment property, or whatever that looks like. Or maybe I'm going to go buy an investment property.
Right. And that can help bridge that gap. That cash out that you take out, where that down payments on the rental properties, the rental properties interest rates, from what I had my first rental property interest rates they're significantly lower as well. And so if we can help bridge that down payment gap with the cash out refinance, then, it still is not going to be the end of the world if you buy your investment properties as investment properties, which is what I did, right? If you're able to have the flexibility of living in the different primaries, and being comfortable with the disclosures that are signed there, then that can be something that can be strategically utilized. But I'm trying to be as clear as possible with representing kind of my side, where there's let's come up with a strategy or or contact your trusted lender, because the rules do change a lot. And so I just want to manage everybody's expectations to where, they're not saying, hey, Matt told us we could do a cash out and then immediately buy this other property. So,
yeah.
so we want
For clarification, Matt are not advocating breaking the law. We are simply looking at how we, we play this game to our advantage. Now, it may not have to be an investment property in the truest sense, but I could buy a second home. Yeah. And the down payment requirements are a little bit different. Maybe I do want that mountain retreat, right? I'm going to pull up and go up to the mountains for a second home. And again, there's some requirements. There's things that have to be met. So, make sure you cross your T's and dot your I's, because not following the rules, the city and municipality guidelines for Airbnb has gotten people thrown in jail. So I don't know about you, Matt, but getting thrown in jail has like adverse effects for me accomplishing my life goals and raising my son. So
I can't afford that route.
No,
that's right.
I don't have enough cash flow to be thrown in jail. And I'm not a very big guy. I would not survive very long in jail, right? But maybe it's a beach property, right? Maybe it's a beach property that we go to, and spend time down in there, right? So there's opportunities there to kind of leverage that.
And that's why I love my job, because I get to talk to clients that, they can dream with me, and we can say, hey, it'd be nice to have a second home in this area close to my family, or, a lot of different, every client's unique, and so when we have these brainstorming planning sessions, we can maybe identify, some of these really nice fits for some clients to buy a second home that then they can short-term rent, but then they could also utilize. Second home, I like to think about second homes, you need 10% down, which is a lot better than 20. And also interest rates are just as good as primary residence rates, when you're looking at second home. So a lot of advantages there. Some of the cons would be that it has to be a certain a distance away from your primary residence, and it has to meet those second home criteria. So, knowing that, and you mentioned it, there's the rules of the game. And, I have to mention that, I grew up in a board gaming family, right? And it always mattered to learn the rules before you play, right? And most of the time, I got a smart older brother. He would figure out how the game was broken and exploit that rule, And so it's just been the ways that we look at things. I'm not saying exploit anything, but we have the rules of the game and we have your goals. And there are so many more rules than people can possibly imagine. And so it's worth spending the time to really dig deep with clients and really dig deep with your loan officer and make sure that you trust each other, because this is a very high level strategy that we want to come up with. And there's a lot of different rules and there's a lot of things that we want to navigate. So take the time to ask the right questions. And the great thing about our job, and about utilizing the lender is none of us get paid unless you close on a mortgage that we finance, right? So it's so funny because I feel like not more these days, but I felt like there was a time period where I'm like calling people like, hey, pick my brain. I'm like, why wouldn't people want to know at least what I know? I'm not telling them they have to go with me, I'm just, at least hear me out, right? And now, it seems like, people are more coming around to the strategy to, hey, you know what, let's not get caught in this game of click a button, get a mortgage, get the lowest rate. That's all you need to think about. Listen to the big mortgage businesses that have enough money to advertise during the Super Bowl. They're the ones that have your best interest in mind. Exactly.
Right? How much of the Super Bowl ads? Are they $5 million?
At least, right? At least. And so, I always kind of have a little chuckle at that because, hey, you mentioned I'm a local boy. I grew up in Arvada, Golden area. I live in the Highlands area. I've been doing this job ever since I'm 22 years old. You know where to find me. And hey, I'm not looking to, to screw over anybody. I'm looking to help people with my knowledge, right? And that's how this feels because, there's a dynamic. There's we all saw The Big Short, right? And we all saw, Schmidt from the New Girl be the mortgage guy who's like laughing about how he's got all these people qualified for houses that they shouldn't be qualified for. And so that's almost like the public perception of the loan officer. And it's tough because it's like, you don't want to trust that guy. But nowadays, you got to trust that guy. You got to trust us with those guys are purged from the industry.
Trust that guy, right? You can trust the guy here on screen, right? Exactly. The other guy's gone.
Those guys have long been purged from this business. Yeah. There may be a few out there still, but really, like, plug in with us. And you know what? Maybe don't just hear us out, and hear the strategy and work with the person who you feel is best servicing your needs, because really there's so many things that you may not know that are options for you that may get you to those goals a lot quicker. And that's what we pride ourselves on figuring out and finding. And if there's nothing that we can figure out or find, it's business. Hey, do not go with us then. If you're not seeing that we're adding value, then please, don't do us any favors. But we do believe that for the right clients who are wanting to plug in and really have that higher level expertise, let's come up with a strategy for you, knowing all these different guidelines that we have to work with. We really think that's the best time spent with loan officers, instead of maybe getting up the phone book or phone book. That kind of dates me. Googling, using that internet and calling the top 10, lenders that come up for the area.
The Google machine. Ask what a phone book is when you get to that Google.
That's right. Exactly. But ask them all their interest rate. Hey, what's your 30-year rate? What's your 30-year rate? What's your 30-year rate? And whoever tells you the lowest is like, that's who has the lowest rate. The businesses and mortgage businesses, they understand that human element, and they prey on it to a certain extent. And I told myself when I first realized how it worked in the business, where I took the highest interest rate possible every single time, that I would never participate in that. Look at our low rate compared to this other bank that's selling the same thing that we're selling, but I'm hiding these fees that I don't want to show you. That's just not the way I'm going to do business. So
without a doubt, I mean, the interest rates are going to be pretty much even across the board. If you take this program with this lender, it's going to be the same as the same program with another lender. So what are the interest rates today? It depends. It varies, right? It varies on so many different factors. So the lowest interest rate, it's not variables. It's not like going to shop for a car. Right. Where it's okay, I know my term is going to be this and my loan interest rate's that's pretty simple. Mortgages are just different. So, ultimately, I think, the message we want to convey here is that it starts with the end in mind, and people have to be able to make that connection as to why they want the rental properties or why they want to make the investments. And truth be told, we are one major life event away at any moment from needing a whole lot more money, right? There could be, unfortunately, car accidents happen, right? Somebody gets in a hospital for an extended amount of time, right? Or their ability to earn income goes away, or they end up with a sick parent, God forbid, a sick kid. It's amazing, right? As we think about, well, I'm doing okay. And unfortunately, okay is not good enough. In best case scenario, these major life events don't impact you the same way. Think about the philanthropic things that you can do, the college that can be paid for, the opportunities to better the community, the environment when you have more money. I've got some friends that just are headed out to India on a mission trip, and they're talking about spending the next 20 years there, right? Yeah. Think about what a rental property would do for their mission in continuing to fund their life's purpose. Now, it's not so they can go buy a Cadillac Escalade, right? It's simply to serve the mission that's there, right? Yeah. So as people make that connection, ultimately what Matt's getting to is work with the loan officer as to specific strategies on how you accomplish your goals, because real estate is a vessel that could get you there. It's not the only vessel, right? You can get in the stock market, you can invest in businesses, you can do trading on futures and commodities or whatever else floats your boat. Matt, you and I are excited about real estate. We have a friend who's a financial advisor who's told us multiple times, we see everything through the lens of real estate.
Yep.
That's what we're in, right? We know it, we can control it a little bit different. That's just where we're at, right? So As we kind of wrap up, Matt, and again, I love the conversation. I really appreciate your time here with it, because these are things that I enjoy talking about and doing, and getting questions answered on. We had a couple of questions that were submitted, and I just want to touch on these as we wrap up.
Yeah, absolutely.
So
and thank you, Matt, for having me, man. It's great to be a part of this. Hopefully we can do it again.
Yeah, absolutely. We'd love to do it again. And again, for anybody watching, if you've got specific questions on anything, hit the chat box, let us know. And I'm probably a little late to be letting people know. I should start that at the beginning.
That's all right. We're here.
One of the questions was, what are the best improvements to increase home value? And I want to touch on that because it wasn't what we talked about today. And the reason we didn't talk about it today is because it really depends. And this is a question about creating rental properties and leveraging real estate primary residence to do that, right? Sharing Matt's story. There's an upcoming video that I'm going to do with a really good friend of mine. She's my Joanna Gaines, Noreen Bolajak, who does our staging for our team. Now, she's got an eye for it. She's got great information on it. But for your rental properties, Matt, there's usually maybe a couple of things that you're looking to do as you pick up those rental properties to protect your cash flow, to protect your investment. So what are 2 or 3 things that you're looking for when you go in, you want to do or update or upgrade?
Yeah. So, and I'm sure your stager is going to have a lot more like breadth of insight on some of this type of stuff. But from a long-term hold perspective, as a property manager, you obviously don't want to put gold toilets in there, and spend as much money as you possibly can. But
because they break toilets. That's
right.
I'm 35 years old. I've never broken a toilet, unintentionally. Somehow tenants break toilets.
Yes, absolutely. So, but you want strong stuff. You want sturdy stuff. You have to have happy tenants. If you get all the absolute cheapest stuff, that things are breaking on the tenants all the time, then it stands for common sense that you're going to get a lot of phone calls, which is going to be an inefficient way to manage that property. So. Don't go all 9, and spend as much money, because that's gonna be your profit. That's gonna be your return. But the two that really kind of come to mind, making sure you don't have, first of all, a structural issues when you're buying a property. But other than
that, if it falls down, the tenants are not paying rent.
What's that?
I said, if it falls down, the tenants are not paying rent.
That's right, exactly. And you may have some lawsuits on your hands. So
1 or 2.
Yeah, exactly. So definitely want to do the due diligence with your inspections, of course. But, as far as, even my house, when there was a great opportunity. When I bought my house in 2009, it may have seemed like nobody was buying a house, but my house had 7 offers and it was on the market for 1 day. I toured it. It looked terrible, because it was just deferred maintenance rental property that, had been that way for the last 10 years. And really, and I did have, again, my dad as kind of the ace up my sleeve, where he's remodeled a few homes at that point, and we were walking through it, and it was just like, wow, this is disgusting, right? And we were walking through it with another group that was actually verbalizing how disgusting it was, and my dad was like so excited, and he was in my ear, and I will never forget it. It's just like carpet and paint. All it needs is carpet and paint.
So you're telling the other folks that are walking through, this place has ghosts. It's condemned. I'm pretty sure I saw the foundation crumbling.
Yeah.
The whole time, just to make sure there's not another offer that comes in.
Yeah. No, exactly. Right. Exactly. But, I think that, without going too into the specifics, I think you want to create a livable space for your tenants. And one of the best things about my long-term rental properties is our tenants. And I learned the lesson the hard way with property managing one of my dad's properties while I was still in college with one of my real estate internships. And I got the police called me a bunch of times when I was still in Boulder for a property that I managed down in South Denver. And it was a duplex, and it was because the family that I put up top weren't getting along with the young kid who was noisy that I put below. Obviously a mistake that I should have saw coming. But, I was so, just wanting to get tenants in there that seemed like fine people, that I wasn't thinking about, how it would fit, how people would get along. And so, it really is worth spending the time to plug in with your potential tenants, look them in the eye, create a good bond with them about the expectations that you're going to deliver for them. And really, when you do that and you take the time to do that and do it in a respectful, professional way, that empowers them to have almost that pride of home ownership. Give them a little bit off maybe market rent if they're going to fix stuff themselves, or if they're going to, have some pride about it, because that's the best money you're ever going to save. And the relationship with your tenants is just the most important. So,
yeah, without a doubt. If you've got bad tenants, it's a nightmare. They damage property. They don't pay rent. They can't get evicted out. And I've got a client of mine. He has a tenant that's been in the property, I think, 25 years. Think about that. 25 years he's lived in this same home as a tenant. How many times over has he paid for that mortgage, for that value, right? And he's happy that, the landlord's almost apologetic, like, gosh, I feel bad, but he loves it. And, I don't charge him full market rent. It's a discount, but those are tenants you want to keep, right? They can keep you in the game very long term.
And like you said about the, kind of giving back thing too, it's just a nice way of having an appreciating asset, but also really finding a way to be a source of, positivity in someone's life, rather than the source where they're going to direct their resentment to if they have some, right? And it's very easy to do that if you're a landlord who doesn't respect or treat your tenants very well. You can have an easy target.
Don't be a jerk. Don't be a jerk, right?
Absolutely.
And for those that are tenants, right, and just want to throw this out there, understand that most rental properties are not owned by millionaires and billionaires. Most rental property owners own one rental property. So if they can't give you 3 months or 6 months off of your lease, it's not because they're bad people, right? These are folks that are also just trying to get through day to day. Maybe they lived in that property, or grandma owned that property, left it to them, whatever that is. So understand kind of the aspect of that as well. But what I've found in my life is if you treat people well, they tend to treat you well back. So that's been my experience with my tenants. I've always tried to give them more than enough leeway to live their life. When COVID happened, the property management company reached out to me, asked me how I wanted to handle it. And I said, well, if she hasn't reached out yet about not paying next month's rent, just give her the option. She can do it if she wants. She doesn't have to. Truth be told, this is in a really low income place, and she doesn't always pay rent anyways. So I may have not been losing anything. But one last question. Again, we didn't touch on, because again, not the scope of this conversation, but where to park money until that investment property falls into your lap. And you and I had a conversation offline about this. That's a much better question for a financial advisor. The big thing you and I discussed is there has to be a good paper trail and access to that money. So there's a seasoning requirement, right? When I say seasoning, not talking about salt and pepper, we're talking about how long of a season it's been in the bank account or somewhere where I can verify that. So I know a past client of mine pulled money out of a safety deposit box to put down his down payment, and that threw a big wrench, almost cost him the house. Now, he had the money legally. It wasn't like he knocked over a 7-Eleven to get this, but there has to be the paper trail. So one, make sure that it has a paper trail. You can find it, because the bank wants to know where the money came from. Mm-hmm. And two, that it's easy to get to. If the folks holding on to your money, whether that's in a 401k, it's grandma, it's whatever, if it's not easy to get to, that may cost you the opportunity. And sometimes really great opportunities, they have a shelf life. Mm-hmm. If you wait, you may not be able to take advantage of that. So wanted to address on those two. Anything we haven't touched on that we can just, wrap up here with, or if you could leave them, let me rephrase it. If you could leave everybody with one parting gift, right? A phrase, a concept, what would that be?
That's a great question. And real quick, I'll just touch on that down payment piece. Again, to echo, make sure, because a lot, the layman who doesn't maybe know how the regulations and mortgages work, hey, I got this money in a under a mattress, in a 401k, in this whatever, and that's fine, right? That's got to be good enough. And
yeah, I got my money.
Right, exactly. But since 2008, and since the regulators got into this business, unfortunately in some ways, fortunately in some ways, but it feels like it's, instead of the fog of mirror where it's innocent until proven guilty, right? Where it's more of a guilty until proven innocent approach to this underwriting process, And so as far as our training is concerned, the way that why we have to document assets so exhaustingly is because to combat money laundering and fraud and all this illegal activity, that this is where a lot of the money can be utilized, can be laundered, and so that's why it's very it's gone over in excruciating detail as far as where those assets come from. And if we see if you are planning on buying a house, then I would probably say that for the smoothest transaction, get into a savings or a checking account 2+ months prior, because there's a 2-month seasoning requirement. And if there's no large deposits and 2 months of bank statements and you got an end balance there, that's all we need, right? But if there are all these large deposits and different things coming in, it's like, well, you're asking the underwriter to just like, wait a second, who are these people, right?
Yeah.
Leaving that kind of there, of the parting piece, I would say is that if I would, the mortgage people try to, project this, hey, it's easy process. It's so easy to get a mortgage through us. It's so easy. It's so easy. We're all dealing with the same rules, and it's not that easy. We have 2 people in our team that even for 800 credit scores in the box, there's still rules, there's still regulations, there's still things changing. And so my biggest word of advice would be, gosh, utilize your loan officer, utilize their knowledge. It doesn't have to be me. Like, we got a lot of clients, like there are a lot of really good loan officers out there. We would love to work and share our knowledge with anybody out there, but it's just such this huge value that I don't feel like the public takes advantage of enough, right? Because we're free. We're free to our services. It's like, hey, why not give me a call up and see what I think about something? You can get off the phone with me and say, that guy doesn't know anything, and call up the next guy who's going to tell you a lower interest rate if you want to. Whatever, like that's my goal, is to, when I first got into this business at 22, I almost, like, it was almost a knee-jerk reaction. I'm like, I have to call my friends. It's wrong. Like, we understood it wrong. They're teaching it in business school wrong. Like, we shouldn't be obsessed with this lowest interest rate. And what they hammered us in business school is like, oh, look at the amount of money over 30 years. And like, of course, if that's the calculation that you're comparing everything to, the lowest interest rate is always going to be the best winner in 30 years. But
we just know human nature is very different, right? Most people are buying and selling homes about every 7 to 10 years. So the expense over the 30 years almost becomes irrelevant to some level. So we look at it at a smaller scale as to what it's actually going to cost or save or do. Mm-hmm. Working with somebody who understands the game that you want to play is going to help you accomplish that. And knowing that your goals, your objectives, they may change, and that's okay too, right? So mortgages, it's not like checkers, especially when it comes to real estate investing. So many different things you can do, should do, don't do's. Don't go at it alone. Make sure you've got trusted resources who understand it. And I'm a big fan of working with lenders who also invest in real estate when I'm talking about investing real estate. It's the same reason why I wouldn't go get a tattoo from a guy that doesn't have any tattoos. I'm not going to trust the chef who doesn't eat meat on preparing my steak, right? It's no judgment on their lifestyle. It's just, you don't really know what it is that we're doing here, right? So
Yeah, and you know what? That's what we used to talk about. I got two business partners. One is my former mentor. We worked together at Wells Fargo. He's got 25 plus years of experience, and then my other business partner, Nate, he spent 10 plus years in the big law field, working at Holland and Hart. And there's a lot of value that we can bring, and there's a lot of knowledge that we can tap into, and Andy who's been in this for 25 plus years, and he's always been a consummate professional. That's why I feel very lucky that I started, that he hired me in 2007. But he was mentioning kind of anecdotally, like, hey, back when I was doing this, in the 90s and in the early 2000s, mortgage guys were looked at, and we were kind of like used car salesmen, and
we saw The Big Short. That's what exactly they were. In fact, I think, from if you pull people immediately after watching that movie, it is used car salesperson and then the mortgage industry.
Exactly. We're even below it. It's true. It's so true, right? But it's created this kind of shift with, and I'm not trying to be egotistical at all. There's plenty of very good lenders out there that we're trying to get better every single day. But these days, it used to be closer to a used car salesman. These days, it's closer to a high-level CPA, financial advisor, that there's all these regulations and rules that you just can't be aware of if you're not in this business. How would you be, right? We're reading through hundreds of pages of guidelines, and I got, part of our team his sole focus is almost like making sure we're updated on all the different guidelines that are changing. And so, from that aspect, we're the used salesman got kind of purged out of the business. And so you're still going to see some people that maybe treat it like that. But that's kind of a red flag in my eyes, in my estimation, to maybe call the next person down the list and see if they'll take the time with you to sit down and listen to you and learn about your goals and learn about who you are and learn about, because maybe your goals, like, we're going to add something. We're going to say, hey, you know what? You can actually do this and get to your goals a lot faster. That happens with most of our clients, because the amount of things that we're aware of behind this curtain, it's just impossible to know if you're not in the business. So, get yourself a good team together, find yourself a lender, real estate agent. Matt, you're a fantastic real estate agent.
I mean, if they're watching my Facebook feed, right, please reach out to me.
Yes,
there are no other real estate agents.
There
I am
are
the
no
only
other
one,
real estate
right?
agents. Matt, you are,
Right.
I'm serious, when I say that. You're a fantastic real estate agent, and you represent your clients very well, right?
Well,
but
thank you. I appreciate that.
But I'm sure you can say the same thing, where there can be a variance, like a wide variance of skill sets when it comes to real estate agents. It's the same type of thing with loan officers, and find the right fit for you, and that's why we even have different personalities on our team, because I may not be as loud and aggressive as maybe some people kind of need that direction. I'm more like, here's the info. You tell me what you feel like. And some people need it more. My business partner Andy, he's a little more assertive about certain things, and some clients feel a lot more comfortable with that dynamic. And so we got thick skin. If it's not vibing with me, I don't take it personally. I don't expect anybody to do business with me if they're not seeing that there's a value there. And so, to reiterate the team aspect, yourself, a lender, a strong lender, I would say, a stager, like you said, a financial advisor, a CPA, and probably a contractor if you're looking at really trying to invest. So.
Well, and I think you and I share the same sentiment is, we're passionate about helping people accomplish their goals. And if accomplishing their goals means that, they ended up finding somebody else that handled, the transaction, as long as it was handled well and professionally and the clients got what they were looking for, I can sleep okay with that. Right. It's the ones where I have the story where things really blew up or did not go well, that it really just, it breaks my heart. Right. I feel crushed. Like, man, it really could have gone so differently. And in the end, very excited for them to get their home and move forward. But, a lot of different things there. So, Matt, dude, hey, I really appreciate the conversation. I appreciate our chat. We're going to have you back in the future to talk about real estate investing or maybe some other topics,
Yeah, please.
really kind of audience choice as we talk to Matt and all of the other folks that we're doing these live video interview series with. So,
Yeah.
Cool.
Yeah, absolutely. Whatever questions, whatever comments, anything that you guys would like me to touch on in the future, I'm happy to do it. It's almost like, I've been in the mortgage business for so long and I'm nerd out about it. I almost I want the riddle that I can't figure out, about someone asked a question about, I heard this about mortgages, I'm looking for those curveballs. It keeps us on top of our game. And so anything out there that you guys are hearing, let us know and we'd be happy to have a conversation about it.
Awesome, Matt. Well, I'm going to let you go.
Cool.
You have a wonderful evening. Get home to that wonderful wife of yours, and we'll connect with the Facebook audience again here in the next couple of weeks.
Absolutely. Tell Brennan I said hi, man.
All right. Be well.
We'll see ya.